So thank you all for coming out tonight. This is the Tax Reform Update webinar. My name is Jeff Badu. I'm a licensed certified public accountant in the state of Illinois. I'm the owner and practitioner of my firm, Badu Tax Services, and we specialize in tax preparation, tax planning, and tax representation for individuals and businesses. So really the purpose of today's webinar is to provide you with an update of the tax reform, all the different things that are going to be happening this year. It's actually effective as we speak. So about the first 30 minutes or so, we'll be going through just a quick update. I won't go through every single thing. There is over 1,000 pages in the new tax code. But this one is meant to be a more short, sweet, simple, to the point. So the first 30 minutes really will be dedicated to that. Once again, if you do have any questions, please feel free to type it in the chat box. If you run into any technical issues, you can either text it to me or you can type it in the chat box as well. And so the first 30 minutes will be dedicated to more presentation based. And once again, if you do have any questions throughout the presentation, please feel free to ask it. But we will have a formal Q&A session at the end. Let's say we'll leave about 20 minutes or so, and we'll be ending at 8 o'clock on the dot. So really tax reform, just to give everyone a background of just the tax code in general. So last year in 2017, Congress came together and they pretty much decided to reform the tax code. They made a lot of changes. This is the very first big reform that we've had in a while. And so really with this tax reform, it's called the Tax Cuts and Jobs Act. That is, the purpose is to cut taxes and to provide jobs. Now, there are many different opinions out there. I have my own personal opinions, which I will be sharing some of them. But for the most part, the purpose of this bill really is to cut taxes and to provide jobs to the economy. And so when they say provide jobs to the economy, they're talking about small business owners, big business owners being able to save on taxes so that they can supply more jobs out there. Whether that's true or not, or whether that's logical, that's really up to you to decide. And so the first thing we have here is really the individual tax rates. So tax rates have gone down, as you can see in this chart here. We used to be the highest used to be about 40% or so. The lowest is still 10%. And so now we've cut taxes by about 2 to 3% in each bracket. So overall, tax rates have gone down for the most part, and we still have 7 brackets available. So as you can see here in this chart, we're still, taxes are fairly low compared to, or fairly lower compared to what they used to be. Other changes that have gone on is that the standard deduction has been doubled. So the freebie that we all get on our tax returns, especially for those who do not itemize, we basically have a doubled standard deduction. And so if you do not itemize, you will definitely benefit from this because the standard deduction has been doubled. So if you do itemize, unfortunately, itemized deduction has been limited significantly, and we'll be touching upon this quite a substantial amount throughout the presentation. And then personal exemptions, this is huge. This will affect a lot of Americans. Unfortunately, personal exemptions are gone now. So if you have a child, pretty much everyone used to get a freebie of $4,000 in deductions or write-offs. So overall, now they've taken that away. So for every member of your family or every dependent that you have, including yourself and your spouse, you would get $4,000 write-off. And so if you had, let's say you had 3 kids, plus the 2, let's say a traditional married couple, a husband and a wife. So we had 2 plus 3, which would be 5, and then you multiply that by 4, which would be $20,000 in deductions. Well, now they've doubled the standard deduction, and you would only get $12,000 extra. So you would be losing essentially $8,000 worth of deductions. So if you have, let's say you have more than one child, so the balance really happens when you have one child. So if you, husband and a wife plus one child, that's three exemptions. And you multiply that by 4,000, that's $12,000. Well, they increased the standard deduction for a married couple by 12,000, so that's when you really even out. But as you go up to more kids, unfortunately, you do lose a benefit. However, there is something that was something that contemplated, or there was something that compensated for that loss, which we'll be talking about later. So overall, the standard deduction has been doubled. So if you're a single individual, you now get about $12,000 in the standard deduction. If you're a married couple, you get $24,000, as we can see in this chart. So back up with itemized deductions. So unfortunately, this is really big in the tax code, and this is something that they were working on a lot, and that a lot of the itemized deductions have been limited. Well, for the first one is you have medical expenses are now the threshold. So you used to have to hit 10% of adjusted gross income in order to deduct your medical expenses. Now, I would say this, a lot of Americans are not able to deduct their medical expenses. So this didn't really have much of an impact. So now it's dropped down to 7.5%. And if you just joined in on the webinar, thank you for tuning in. We'll be going through some material really quick, and you can feel free to shoot any questions you have, any clarifying points that you need. Please put it in the chat box. So thank you for tuning in once again. Now back to the presentation with the state and local. So state and local income and property taxes have been limited to $10,000, unfortunately. This is probably one of the biggest things of the tax code. And that if you have, so let's say you pay $10,000 in state income taxes. Well, off the bat, you've already maxed out your $10,000 limit of state and local income and property tax deductions. Now, let's say you own a mansion and you pay $20,000 in property taxes. Well, that $20,000 would be lost. So unfortunately, a lot of people won't be able to itemize starting in 2018 because their itemized deductions have been limited. So just something to keep that in mind. And then also, so one way to combat this effect is that what you can do is you can turn your personal property, so your home, let's say you have 5, or let's say you have 10 bedrooms and it's only a married couple. Well, I know for a fact you won't need all 10 bedrooms. So what you can do is you can Airbnb. You know, they have, for those not familiar with Airbnb, it's like basically having a hotel in your home. So you can Airbnb some of your units, or you can turn it into a long-term rental property while you live in, part of the units. This works really well when you have an FHA loan, Federal Housing Authority loan, and you buy a multi-family. So let's say a 4-flat, a building with 4 units in it. You live in one unit, you rent out the rest. So that way, this $10,000 limit only applies to the unit you live in. The other 3 units won't be impacted because you still get the full property taxes. So when it comes to this section, this only has to deal with the personal portion. This only has to deal with you as an individual and none of your business activities. So in other words, if you have over $10,000 in property taxes business related, you can absolutely deduct it. And so one thing I'm encouraging a lot of my clients to do is to start a business, is to buy real estate and try to turn their personal properties into investment properties as well, especially if you have multiple units. So for those that don't have a home, if you're looking to buy, you probably don't want to buy a personal only or an individual only use type property. So you don't want to buy things like a condo. You want to get something that's a little bigger as far as the units. So you want to get a 4-unit, a 3-unit. That way you can live in one unit, have tenants pay your mortgage for you basically while you build up some long-term equity, some cash flow on top of that. I'm actually coming out with a book on real estate, which should be released by the end of this month. It's a pretty short book. It's not a heavy book, but I talk about a lot of these different things in the book. But in the most part, I really wanted to pay a lot of attention to this portion because it is huge. So if you're a high net worth individual, if you own a big property, you unfortunately are limited to only $10,000 in state and local income and property tax deduction. So imagine if you pay $30,000 to the state, plus you own a property and paying $10,000 in property taxes. Well, now you're only able to deduct $10,000. You would lose the $30,000. And luckily, they did compensate this a little bit with the standard deduction being doubled. But overall, I don't think that's not nearly enough. You're losing $30,000 and you're only gaining $12,000. And then to put a slap in the face, you're also losing your exemption. So unfortunately, when it comes to taxes, and this is really a secret of the tax code, is that it truly benefits those who own businesses and also those who own real estate or those who invest. So people like Warren Buffett, one of my biggest idols and mentors, his tax rate is essentially 17%. The average American pays 40% in taxes. The reason why is because he structured his income differently. All his money is from investments. He does receive a W-2, but it's in the form of investments. And so remember back in the day, Bill Gates, he had a salary of $1. The reason why was because he shifted his income in a way where he got taxed at a pretty low amount. And so with the tax code, it really benefits those who own businesses and also those who invest, especially in real estate. If you're a real estate investor, you are the second biggest winner in this whole tax reform. Now they've accelerated things known as depreciation, so you're able to write things off a lot quicker on your tax return. You're able to 1031 exchanges, so if you own a property and you wanted to trade it in for a bigger property and avoid taxes altogether, you're only limited to real estate now. So at first you could trade in your car, maybe it went up in value, which usually never happens. So overall, you as a real estate investor, you definitely benefit a lot when it comes to this new tax code. So if you don't own a property, if you haven't utilized your FHA loan yet, please go ahead and do so. And once again, for those tuning in, please thank you for joining us today. If you have any questions or anything like that, please feel free to put it in the chat box. I would say I have another about 20 minutes or so of material, and then we'll be going into the Q&A section, the formal Q&A section. So if you have any questions, you can either shoot them out now, you can wait until the end. So at about 7:40, we'll be doing a Q&A segment, and I'll be stopping at 7:40 as far as the material goes. And so the $10,000 limit, that's huge for individuals. And then, so I know some people were prepaying their property taxes, which was a pretty smart thing to do. And so other things, deduction on mortgage interest is still available, but it's now slightly limited. Not really a big deal. So overall, the biggest things here, biggest point, there's no personal exemptions anymore. And the standard deduction has been doubled roughly. So just something to keep in mind. And so those are really the big ticket items. And then also if you work a job, so if you had unreimbursed employee expenses, maybe you traveled for work and you weren't being reimbursed, unfortunately you can't even write that off now. You can't even deduct moving expenses. So if you move from one location to another location because of your job, now you can't deduct it. So the general theme here is really, it's almost required now to basically own a business. And I'll be talking about more about the business provisions later on. And then you have the child tax credit. So the child tax credit has been doubled. It used to be $1,000, now it's at $2,000. So that's pretty nice. So this is what I was talking about with the personal exemptions. So they've taken away exemptions, but they allow you a credit. So let's just put some numbers in perspective. So let's say an exemption is about, let's say your tax rate is 25%. A $4,000 exemption is essentially a $1,000 credit or a $1,000 freebie, I call it. So really they compensated that pretty nice over here. Unfortunately, if you're above 25%, then you would start losing because 25% times 4,000 is 1,000. But let's say you're in the 30%. Well, now you're at a stage where you're actually losing from the tax code. And I do run analysis for my clients, when for example, for this tax season, so anyone that files taxes through my firm will be getting an analysis of how their income would look pre-tax reform versus after tax reform. So just something to keep in mind out there. And then also there is a non-refundable credit. So if you have let's say you're taking care of your mom, you get a $500 credit for taking care of your mom. So just something to keep in mind. So you do lose. Let's say you claim your mom on your tax return. You would, in the past, you would get a $4,000 deduction, which translated into about, let's say, $1,000. Now you only get $500. So unfortunately, this is one of those things where it sort of hurts depending on your situation. And always talk to a tax advisor so they can, get your situation down, because not everyone is the same. Not everyone is meant to own real estate. Not everyone is meant to own a business. These are just general recommendations. So the child tax credit, that's a pretty good thing that they've doubled that. So it might encourage more people to have kids. Usually when it comes to tax reform, when they do certain things, it's encouraging behavior. So if they're increasing the child tax credit, then that means that they want people to have more kids. Now, so here's the thing: if you have kids in college, I mean to say this in the nicest way possible, but they're essentially useless when it comes to the tax return. So if you have a child in college, usually people they claim them. Well, now if you claim them, for one, you're not getting an exemption because exemptions are gone. For two, you're only getting this $500 non-refundable credit. So non-refundable meaning it won't necessarily turn into a tax refund if that's the only thing left. So essentially what you might want to do, and this is why I encourage a lot of business owners, is you might want to hire your kids, or you might want to hire your college student. The reason why is because you can give them money tax-free. You can pay them a salary, or you can give them compensation and issue them a 1099. Now they have their own tax return. Now you don't have to worry about claiming them. Now they claim themselves and essentially pay no taxes on the income you're giving them while you get the tax deduction. So let's say you paid your child $5,000, you get the write-off up front, $5,000 write-off. But guess what? They don't claim the income because their income is too low to pay taxes. So that's another thing to keep in mind. Now you're funding the child's education. Now they can go out and get their own IRA because they have earned income. They can get maybe a life insurance policy, something like that. So overall, this allows you to teach your kids or teach your college students some business building or some money management principles. So if you have a child and if you have a business, I highly recommend that you hire that child. If the child is under the age of 18, you can actually pay them $12,000. And if you're married, you can pay them $24,000. And they don't pay taxes. Well, as a matter of fact, so the reason how this works is that if you pay your child $12,000, that's the standard deduction. It means that they do not have to file a tax return. So that means they don't pay any taxes. So with the $12,000 part, excuse me on that, the $24,000 part is actually not correct. It's $12,000. So if you pay them $12,000, you essentially get a tax write-off of what you paid them, and then they don't pay taxes because they're below the standard deduction. Usually if you're below the standard deduction, you don't have to file a tax return. And so it's one way to shift income tax-free while you still get the tax write-off. And this is what, this is what the wealthy people usually do when it comes to this tax thing. Another reason why you want to start a business is because this is, in fact, the Tax Cuts and Jobs Act. The reason why tax reform happened was because of corporations, because of companies. The biggest winners in tax reform the biggest winner is the corporation. So if you own a C corporation, you are the absolute biggest winner when it comes to tax reform. Your highest tax rate used to be 35%. Now you only pay 21%. So think about big companies, Apple, Microsoft, General Electric, AT&T. They get to pay only 21% in taxes, while the average American pays 40%. They pay 21% now. And so this is huge as far as tax reform is concerned. So the reason why they did this is, or I guess the reason why people think they did this, is because the lower the tax rates are, the more jobs are going to be created in the economy, meaning that they have more money to hire people. Well, this is a little bit false, just due to the greedy nature of companies in general. It's in reality, I don't really see the difference in, more jobs will be created just in general. But at the same time, I don't really think that cutting a company's tax rate from 35 to 21% will necessarily make them hire more people, especially in the US. If I'm paying somebody $4 in India versus me paying $20 in the US, I'm still going to hire that $4 person because they're at a lower rate, especially if they're doing the same amount of work, the same quality work. So if I'm getting people, cheaper in another country versus here, this whole tax reform thing, it only makes my life much better. So although they think that I'm going to hire somebody that's worth $20, I'm still going to hire that person that's worth $4. So this is a little bit on the debate side, but overall, this is what we face. This is the biggest part of tax reform. This is the number one reason why tax reform was created, was to lower the taxes for the corporation. Now, if you're a small business owner, you are not left out at all by any means. You actually get a new 20% deduction. So in here, we get a new 20% write-off if you own an S corporation, a sole proprietorship, a partnership, not a C corporation, because we've already done enough for C corporations. So now we have to focus on S corporations. And so what you do here is, it's a really simple calculation. You take your net business income and you multiply it by 20%. And so 20% would be your deduction. And then ultimately 80% would be how much you pay, or how much your taxable income now is. And so you take your net taxable income, multiply it by, let's say, 80%, and that's your new taxable income. So this is big. Let's say you make $1 million, you netted $1 million in your business. Well, now let's say you only netted 800,000 because you get this new 20% deduction. Now there are limits in here. I will not go through these because they are extremely complicated. So if you earn, let's say you've been paying yourself a lot in your S corp, which a lot of my clients do not do. So if you have S corp wages, or if you have W-2 wages of up to a certain amount, you essentially, you're either phased out, you're limited, or you just won't be able to write it off. And this is more so for S corp income. So usually I don't recommend my clients paying them this high of a salary. There's a different calculation that I like to use. So this is another reason why you might want to start a business. This applies to Uber drivers. This applies to people who sell products on Amazon. Unfortunately, if you are a doctor, an attorney, a CPA, a consultant, unfortunately, this 20% deduction gets a little more debatable, in that you won't necessarily get the 20%. Now you fall in another bucket and you have to go through another set of hoops. It doesn't mean that you won't get it completely, but you do have to go through extra hoops in order to get this new 20% deduction. So for my firm, for me, for example, as an accountant, I have to go through extra hoops to get this 20% deduction. And I have an LLC that's taxed as a sole proprietorship. Soon I'll be moving to an S corporation, or an LLC taxed as an S corporation, in order to take advantage of this deduction. So there's a lot of debate with this, but just for now, just think about it that if you earn, let's say, $1,000, just take 20% off of it, and that's how much your taxable income is, and then you multiply it by your regular tax rate. Because remember, These are pass-through entities, meaning that they pass to your personal tax return. Not these aren't. So for an S corporation, for example, does not pay income taxes per se. It flows to the individual, and then the individual pays income taxes. So all that money goes to the individual's tax return. So other things, really, so retirement plans, this is not too important. If you're living pretty nice and you have estate taxes, or you face estate taxes, the estate tax deduction or exclusion amount has been doubled. And then also, if you don't have health insurance after December 31st, 2018, you no longer face a penalty. And other aspects of the provision or of the tax code is, so for alimony payments are no longer taxable for one who's receiving after a certain date. If you get divorced after a certain date, alimony is no longer taxable, which I don't like to tell too many people, but I absolutely must let them know because this is, in fact, tax reform. So overall, those are the big changes in the tax code. Really, I think that I personally don't really like it, to be honest. I believe that this really benefits those with a ton of money, those who, essentially corporations. Ultimately, this benefits those who have the capable resources, and it sort of slims down the folks who don't have as many resources. What this will ultimately do is it will lower taxes for the big businesses, which will end up increasing their stock prices or increasing their bottom line, which will in turn increase their stock prices. So if you don't own stocks or anything like that, I highly recommend that you get involved and you become an investor, because these companies' bottom lines will be getting bigger in the future. So think about Amazon, Microsoft, General Electric, AT&T. All these companies, their stock prices will more than likely go up in the future, as far as this tax reform is concerned. And so usually when you give something to somebody, you have to take away it from somebody else. And so unfortunately, those who don't have as many resources as the big giant corporations, it's not necessarily that we'll be hurt, but we won't get as many benefits as those that are up there, especially when you're taking away exemptions. So I'll give you a quick scenario. Let's say you have 5 kids and they're all in college, where you're basically, pretty much the tax code has really, really screwed you over. Because for one, you're talking about 5 kids times $20,000. So you would be losing, essentially, $20,000 in write-offs, even though it's compensated by this $500 non-deductible credit or non-refundable credit. So $20,000 translates to about $4,000. 500 times 4 is about $2,000. So you're losing about, let's say, 50% of what you used to be able to get. But for the most part, from doing some tax returns so far this year, I have seen some good news, especially for those who do not itemize. I ran some scenarios for some of my clients, and they ended up getting a bigger tax refund, or they ended up receiving more money. So just one thing to keep in mind, and also this is very debatable. The IRS has come out with new guidance, but since you don't have exemptions anymore, remember on your W-4 you used to put 2 in box 1, 3 in box 2 here and there. Some people put 12. I have an aunt that did 12 last year. So unfortunately those are gone pretty much because exemptions are gone. And so what this means, or logically what it means, is that your paychecks will be smaller up front, but you would get a larger tax refund in the, essentially you would get a larger tax refund when it comes time to file your taxes. So overall, I have mixed opinions about the tax reform. I think it benefits the corporations a lot. I think it benefits small business owners to a certain extent. Unfortunately, they got rid of entertainment expenses for business owners. This is huge. So if you took clients out on a golf course or things like that, there's no longer a deduction for that. Meals luckily did stay, business meals did stay. You can still deduct those up to 50%. So those are the big key areas. I have, like I said before, I have mixed opinions on this new tax reform. Um, I, I really don't think it's going to help the corporations, absolutely. But I don't necessarily think it will help those that people think it would help, meaning a middle class American or just Americans in general, your average individual. So overall, though, we have opportunities to take advantage. Anytime there comes new law or there comes new rules, it means it's time to take advantage of those rules. And so if you don't own a business, this is the perfect time to own a business, especially in the state of Illinois because LLC fees, the filing fee went down from $500 to $150. So it's the perfect time, and I believe this is strategically planned. It's the perfect time to start a business. It doesn't have to be anything big. It can be something small. Absolutely must own a business nowadays, especially when they're taking away all your W-2 deductions. Another thing you might want to consider is moving from a W-2 to a 1099 because W-2 deductions are extremely limited now. As a 1099, you get to decide when you want to get paid. So usually the strategy works this way. Somebody was receiving a W-2. They asked their employer to trade that for a 1099. The 1099, they go out and start an S corporation. The 1099 gets paid to the S corporation, and then the S corporation would pay you or the owner. Now you get this new 20% deduction. W-2s, there's no such thing. So you pay yourself a minimal salary, just enough to keep the IRS off your back. You pay yourself that salary, and then the rest is pretty much, for one, you don't pay payroll taxes on the rest of the money. I usually recommend 25%, so about 25 to 30% in W-2 payroll, and then the other 70 to 75%, I usually recommend that you do that in the form of, just dividends or just net business income. Now you use that money, get a 20% deduction or freebie, and now you end up paying less taxes. Now you still get your health, you can deduct your health care. You can deduct travel expenses, meals, not entertainment, but just meals. You can deduct automobile, all the different things in the world. As a business owner, you get to deduct basically everything. And so that's really the presentation in a nutshell. I hope everyone got some insight out of it. I did send this PDF out as a newsletter, or I sent it out in a blast. So if you do need it, please feel free to email me at jd@badutaxservices.com, and I would be more than happy to email this to you. I actually did a tax reform webinar with another one of my close partners or affiliates, and we also have that recorded. This will be recorded, so if you feel like you missed anything, I will send this out to those that attended, so you will have this available. And now I'll open up the floor to any questions that you may have. If you do have any questions, please feel free to type it in the chat box. There's a chat feature in join.me. Please type in your question. I'll be more than happy to answer it. We have about 20 minutes or so. And if we don't get any questions, then we will cut the webinar short. But please feel free. This is really the main purpose of the webinar is to provide you really with an update and just ask any questions that you have. And of course, for my clients that have the tax plan and package, please go ahead and let's schedule a meeting. Let's put time on the calendar, and we'll definitely be able to sort all of these different things out. But as far as the presentation goes, that's really it in a nutshell. If you do have any questions, please feel free to put it in the chat box. I'll be more than happy to answer any questions you have. And I know there are some questions out there. This is definitely not something to be overlooked. This will impact people. It really hasn't started being felt yet because the IRS is behind right now. They're pretty much backlogged. But overall, this is something that's very important. It will affect everybody, not just the corporations, not just us, your kids. Everybody will be affected. So it's definitely important to be able to be proactive. That's when it comes time that's what it's all about when it comes time to this stuff, is to be proactive. Those with the best advisors will pay the least in taxes. So just different things like that. And if you don't have a tax advisor, I highly recommend that you get one, because it can save you quite a tremendous amount of money. And so really that's the webinar and the presentation. Okay, so we do have a question here, and it is there a minimum age on a child you can pay through your business? That's a great question. So we absolutely don't want to face child labor laws. That's something we don't want to break. We don't want to break child labor laws. So usually it depends on what profession you are in. I would say at the age of 7 is a great time to start paying your child. They can do a lot of great things. At that age, they can do something. Whether they're your office trader administrator, whether they're your bookkeeping assistant, whether they're on your board of directors, you can always have a position for your child. And when you're teaching them these things, there's no way they're going to misuse your money in the future, because you've been teaching them these business principles. So there's no minimum age really, but I would proceed with caution. I would not hire a 1-year-old and claim them on and say that I put them on payroll, because what can a 1-year-old really do? I mean, they can be a model, they can be the face of your business. But you definitely want to be careful. Please speak to an attorney as far as before making that move. But I would say 7 years old is a good age really to start that process. And for those that don't know what I'm talking about, usually if you have a business, you can hire your children as young as, I would say, age 7. Pay them up to $12,000. Put them on payroll. Pay them $12,000. And they don't pay a dime on their taxes because they don't file a tax return, and you get the $12,000 deduction as compensation, or as you paid them compensation, as you would have paid anybody else. You have to hire somebody anyway, so you might as well hire your own children. And that way you save a lot of money on taxes. They don't pay any taxes. They can get their own IRA, their own 401k. They can get all of that stuff. So that's something I really push, is to make sure that, as we build income, as we generate money, as we own businesses, we want to pass that on or build that multi-generational wealth, and do it in a very tax efficient manner. So definitely thank you for that question. So please feel free to shoot out any more questions. We have about 14 or so minutes left. Anything that you're confused about, anything, I mean, this is anonymous information. I definitely appreciate this next question. Did you mention anything about the EIC? How is that affected? So the EIC really didn't get changed. They always adjust the thresholds, or they always adjust the inflation amounts as far as like how much you need to get to. But earned income credit in general was not really impacted. It's overall, so earned income credit, for those that don't know, it's more so for the lower income individuals, or fairly lower income individuals. And ultimately, or if you're a business owner like myself and you claim minimal, you basically write off everything to the bones of it, you get a credit known as the earned income credit. And so the earned income credit is essentially a freebie. And depending on how many kids you have, you get this deduction. If you don't have any kids, you still get the deduction. It's just a lower amount. So the more kids you have, usually the more you get. And that's why a lot of people line up at the tax, in front of the tax offices, saying they want their refunds because they get this earned income credit. But it's essentially a freebie for working. So it encourages people to go out and work. Usually if you don't work, you don't get any tax benefits. Or if you don't own a business, you don't get any tax benefits. And so earned income credit is really in its name, is that if you earn income, we'll give you a credit for that. So I'm definitely glad that question came about. So earned income credit did not change at all, really. So we still have about 12 or so minutes. Please keep the questions coming. Remember, this is anonymous. That's another reason why everyone has been muted on the call. The questions, definitely appreciate any questions you may have. This stuff is very important. If you want to take this to the next level, please let's schedule a meeting. You know, for all my new clients or all my clients that do not have tax planning, I always offer a free 30-minute initial consultation. So if you want to take this to a deeper level, maybe you want to find out more about the whole, about hiring your children, or how to set up an S corporation, or how to set up an LLC and different things like that, I can definitely more than happy to walk you through. So right now the main focus is on preparing taxes and different things like that, but it's also critical to talk about this tax reform stuff, because it's happening right now. It affects your paychecks, it affects your well-being, it affects everything, your budget, it affects every single thing. So just something to keep in mind is that this tax reform stuff is definitely very important. So please feel free to ask any questions you have. We have another, let's say, about 11 minutes or so. This is for you. Please shoot out any questions you may have. This is a no holds bar type of webinar or forum. It's really a chance for you to ask anything that you want, and there's no silly questions. There's nothing like that, and everything is anonymous as well. Okay, so let's just give it about, let's say we'll give it about another 2 minutes or so, to ask anything that comes in. So we formally do have 10 minutes, but if no questions come in within the next 2 minutes or so, we'll be ending the webinar. I definitely thank everyone for tuning in. It's always a pleasure to be able to present this stuff. I actually do a radio show every Thursday night, and I talk about topics like these, 7:15 to 7:45 p.m. on a station called WGHC 98.3 FM. And you can also go online at wghcfm.org, and you can listen. And I also post it on my website. My personal website is jeffbadu.com, jeffbadu.com. Or you can also subscribe to my firm's newsletter at badutaxservices.com. So we do have another question in here. Do you think companies will be hesitant to transfer you from a W-2? I believe you mentioned to ask your company to change you from a W-2. So I don't remember exactly what kind of form you should change to so you can start an S corp. You know, that's a great question. So there's a lot of gray area in this, and it's really a hard thing to do, to be honest. But let's just say, so let's answer the first part. Do you think companies will be hesitant? Yes, they would be hesitant. But at the same time, you might be saving them a lot of trouble by going to a 1099. Because as a W-2 employee, you are basically, the company is responsible for everything you do on their premises. So as soon as you step foot, let's say you work at Microsoft, as soon as you step foot on Microsoft's headquarters, Microsoft is now liable for anything that happens to you. You slip and fall, maybe you mess up somebody's software, something like that. They would sue Microsoft and not you personally. But as a 1099, you have that liability now. So that's not the main purpose, of course, of switching to the 1099. The main purpose is that you're shifting your income in a way that ultimately you avoid, for one, you avoid paying the heavy payroll taxes. So all the money that's getting out of your paychecks. Now you completely avoid that. You don't even have to pay a dime throughout the year in taxes, really, unless you make over a certain amount. So now you're getting all of that money up front without having to worry about exemptions and payroll. You don't have to worry about any of that. So what you do is you tell your employer that, hey, I see this new tax reform thing came out. I want to change my income around a little bit because this tax reform is really going to impact me. It's going to affect my well-being. I'm going to lose a lot of my deductions. And so what you can do is you can say, hey, Microsoft, or hey, company, can you please move me from a W-2 to a 1099 as an independent contractor? well, guess what too? You wouldn't be liable for a lot of the things that I do now. So now I would have to go out and get a lot of different, or a few different things. You might lose your health insurance, but hey, you can easily go out to the marketplace, um, pay a very minimal amount, because now you're going to get the premium tax credit probably, because you're going to strip your income down so much. But basically the way it works is that you're shifting the way you get paid from a W-2 to a 1099, in that they pay you in the form of a 1099, so they still send money to the same bank account. Or as a matter of fact, let me actually change that. I'm sorry. So after they say, okay, yes, we agree that, some companies won't, some companies will, but after they say that we agree to make you a 1099 independent contractor, now you go out immediately. One of the first things you do after you're done celebrating, you go out and you form an S corp, or you form an LLC. I'm sorry, an LLC taxed as an S corporation, because LLCs have less maintenance, less headaches. So LLC is my number one recommended type of entity to form is an LLC. You have the LLC, you can choose it to tax it at any way you want. You tax it as an S corporation. The 1099 gets issued, or the money, so you go out and get your bank account for the S corp. Your employer sends the money to the S corporation directly, no questions asked. And then the S corporation pays you whatever you want. Let's say 25%. That's what I usually recommend, in a form of payroll. But you still get to keep the other 75%, not subject to payroll. And if you don't think payroll is bad, if you've seen those things on your W-2, FICA, FUTA, SUTA, all those different line items on your tax, on your W-2, it's not the prettiest thing in the world. So you get to avoid all of that on at least 75% of your income. And that way, and then you also get this new 20% deduction. So not only are you avoiding the whole W-2, because as a W-2, you're basically restricted as far as what you can deduct, or you're restricted as far as how you want to get paid. They got to send money to you. But now you have this S corp that they're sending money to, and then the S corp is paying you. So now you have another employer, or you're the business owner basically, and you're choosing how you want to get paid. So that's the benefit of going from a W-2 to a 1099. But yeah, it is difficult to get it, especially if you're starting a new job. You want to get some skin in the game. You want to prove yourself a little bit, because you can threaten them to leave if they don't make the switch. And the reason why some companies won't do it, for one, they're legally not able to, because technically if you work on their premises, you're a W-2, you're under their control. If you're using their resources and different things like that, you're basically treated as a W-2. And of course, usually most people would prefer to be paid as a 1099, or the most people that I know at least would be preferred to be paid as a 1099 versus a W-2, because at the end of the day, you save a ton of money in taxes. So that's really what it comes down to when you compare this W-2 to 1099. If you want to go into more detail, I'll be more than happy to sit down, talk to you, go through a consultation and different things like that. So we have about 4 minutes or so for any other questions. Once again, I thank you all for tuning in. It's always a pleasure to be able to present this stuff. Tax reform is very important. It will affect every single one of us, including myself. Even as a CPA, I have to plan my own taxes. And what I'm doing now is I'm starting more businesses. I actually formed 3 LLCs within the past 2 weeks myself, mainly for investment purposes, though, not more so for it's mainly for real estate. Let's just say that. So overall, me as a CPA, I'm out actually. If I tell a client something, I'm usually doing it as well. So for the most part, I'm out starting more businesses. I'm investing more, and overall, I'm taking advantage of the things that are available to me. I've actually not legally paid federal taxes in the past 2 years, and in 2018, or for the 2018 tax season, I won't be paying any federal taxes either, because I plan out my taxes in a way that I legally don't have to pay federal income tax. And that's what I try to encourage. So if you're a full-time business owner, you can enjoy the same benefits. Absolutely. It's just you're switching things now. So instead of everything being paid with after-tax dollars, I pay everything with pre-tax dollars. So for example, let's say a client pays me, well now I pay a bill, or let's say I pay for something. Well, with a W-2, it's usually they pay the IRS first, and then you get whatever's left over to pay your bills. So for me, it's that they send, I get the money, I use it to pay off everything that I need to pay off or invest it, buy some real estate, do whatever, and then the IRS sees something, if anything, which they haven't seen in the past 2 years. So that's one way that owning a business can really help your tax situation. It can save you quite a lot of money. So thank you all once again for tuning in to the webinar. It is 7:59 p.m. If you do have any further questions, please shoot me an email at jb@badutaxservices.com. Please give me a call, shoot me a text at 773-679-7198. You can tune into my radio show every Thursday night, 7:15 to 7:45 p.m. on WGHC 98.3 FM. And I also put these things on my website at jeffbadu.com. I post a lot of different things on there. My book will be coming out at the end of this month. I will be distributing it free of charge. It's in the process of getting finalized. It's a very short book on real estate, on why you really should own real estate. So thank you all for tuning in once again. It is 7:59 p.m. and we will be ending this webinar.